welcome and thank you so much for joining and taking an hour out of your day to join the fourth HomeViews Build to Rent report launch webinar. That was a mouthful. This report, firstly, I want to say a huge thank you to the HomeViews team and the Rightmove team for putting together this report. You will get an email after the webinar to download the report, but it is a huge amount of data, a huge amount of work. We're going to give you today a quick summary of the findings of that report between myself and Tim Bannister, and then we're going to launch into a discussion with, drumroll please, the celebrity panel that we have pulled together, and I'm going to let them introduce themselves very quickly. So I'm Rory Kramer, for any of us that we haven't met or you've seen any of our webinars before. I'm co-founder of HomeViews, and Tim, over to you.
Yeah, hi everyone, I'm Tim Bannister, the Director of Property Science Innovation at Rightmove.
Hi, I'm Catherine Rose. I'm Managing Director and co-founder of Verve Life. We're a third-party operator working across single-family housing, co-live and build-to-rent multifamily. And over to you, Ian.
Good morning, everybody. It's lovely to see such a huge group. I'm a bit of a split personality today. This is my last day as the Senior Director of Build-to-Rent Consultancy at Cortland Consult, and tomorrow I become Head of Operational Living at Bidwell's, something I'm extremely excited about and looking forward to. We provide a full suite of living sector consultancy services, taking you from a blank site to an open and operating building.
And huge congratulations for that, Ian. Fantastic deal and opportunity.
Thank you.
It's my privilege to lead Adam Chalice to lead the UK research and strategy team for JLL, and so that covers the full investor and corporate occupier spectrum across the UK.
Thank you so much. So everyone, this panel was not just thrown together, it's been curated. On this panel you have market leading directly operational experience. Catherine runs co-living buildings, single family buildings, build to rent buildings, and I think that level of experience across the segments is going to provide a huge amount of insight. Ian is helping to consult on and design the buildings of the future and learning from the buildings of the past. Tim has the biggest data set of from the consumer in terms of demand, what they're looking for, and Adam has a view that isn't just of the UK, it's international. So what we're going to try and do today is to really give you a full view of the challenges and opportunities within Build to Rent in 2024 and beyond. Before we get on to that discussion, though, we're going to give you a quick summary of the Build to Rent report. A huge thank you to the sponsors for this year: Yardi, Ask4, Fleet Milne, Bow Concept, Roloku, and 10. Without you, it wouldn't be possible to publish this report, so thank you so much. And I'm going to hand over to Tim, and I'm going to diligently move the slides along for you, Tim. So just give me a shout when you need to talk about consumer trends in Build to Rent.
Great. Thanks, Rory. It's a real pleasure to be here. Second time to sort of be involved in the HomeViews Build to Rent report. So today, in my role as Director of Property Science Innovation, what I do is take the data that's flowing around Rightmove, and that's billions of page views a month. That's hundreds of thousands of properties coming to the site every month. We're one of the top 15 busiest websites in the country, and try and pull out the insights that are going to help us make decisions about property. So I'm going to share some of that with you today, specifically looking at the context of the rental market and then putting a Build to Rent within that. And in terms of the context, what we're looking at the moment is, and I think people who are working in the rental sector will be very, very familiar with this, incredibly fast market. And we had our Q1 rental tracker out today, and prices are up 8.5%. Demand is up significantly, 50+% compared to where it was pre-pandemic. Supply is significantly down on where it was pre-pandemic. So we have lots and lots of people competing for those properties, and that's impacted consumer behavior. So what we're showing here is, for example, on the left-hand side, people are starting to look further to find their next home. So there are these big moves over 50 kilometers. where we know where somebody lives and where they're inquiring to, we can see these big moves have been increasing. And interestingly, they're increasing in length and in the build-to-rent sector more than they are in the PRS sector. So you can see in that chart there, 10% back in January 2019 of inquiries were going over 50 kilometres. That's now up to sort of just shy of 20% in the build-to-rent sector, which is more than the PRS sector. So people seem to be relocating more in the build-to-rent sector than they are in the PRS sector. And not just when they're doing these big moves, but when they're doing more local searches, the area that people are looking to find their next home has increased. So that's the right-hand chart here. It's gone from 60 kilometres squared up to 120 over the course of the last 5 and a bit years. So significant change in how far people are looking. And that really matters because I think, that for the build-to-rent sector, where we're pulling people in from different places, people are a bit more flexible now about where they might find their next home. So I think that plays a big role in the build-to-rent sector. On the next slide, Rory, you can see what we're looking at here is people leaving the city. So there was a strong trend of people staying in cities and inquiring outside of them, so moving out of a city during the early parts of the pandemic. But interestingly, that's continued. It's plateaued a little bit now. You can see that sort of yellow chart there, and the yellow bar on March 2024. But it's significantly higher than where we were pre-pandemic. So this desire for people to sort of look a little bit further, flexibility, initially because of lockdown, but now most likely because of affordability concerns and the pace of the rental market, that is forcing consumers to look a little bit further for the next home. If we go to the next slide, Rory. So where does BTR build-to-rent sit within that context of a very fast market, a competitive rental market? Well, we asked in our survey, our spring survey, do you know about build-to-rent? Have you heard of it? 28% people said they had. So 72% hadn't. So there's a big proportion of people to go after there in terms of educating them about this potential offering. We also asked them, if you know about it, what do you feel about it? Is it appealing to you? And again, it's about 28% said that they found it very appealing or appealing. So there's a good group there that like it. But there's quite a big group that we can pull into that segment as well. 28% were neutral, 9% said not sure. So bringing those people over into finding it appealing. So selling the benefits of this sector is definitely an opportunity for not just raising awareness, but selling the benefits itself is an opportunity for the build-to-rent sector. The next slide, please, Rory. And I think that's interesting. That's really important because the build-to-rent sector is competing with the PRS sector. So here, what we've done is we've looked at the proportion of inquiries sent by people into Leeds, Liverpool, Manchester, city centre and London, where they're inquiring about build-to-rent and PRS. So the vast majority of people, or the majority of people, were inquiring only about PRS. A very tiny proportion, single digits, were inquiring only about BTR. But there's a growing number now inquiring about both. So people who are considering PRS are now starting to consider BTR. And that's growing. You can see Leeds where that's growing an awful lot, where more stock is becoming available. And so people are comparing the two. So you really are competing with PRS. And that's demonstrated by the chart on the right, where we see where there is a similarity between the people inquiring about PRS and BTR, price performance tends to be similar. If you go to the next slide, Rory, thanks a lot. Yeah, I thought it was also worth mentioning the type of offering that's out there. You will see all this stuff in the report, so you can read it at your leisure and look at the maps at your leisure. But what we're showing here is that the single-family homes, so single-family rentals, that's significantly increased over the last few years. That seems to be an area where more and more local authorities have that offering in that local authority. That's how we split it geographically. It's now about 7% of build-to-rent listings on Rightmove are single-family homes. Across the country, it's about 38% of the rental listings are houses. So lots of room for growth there. If you go on to the next slide, I'm conscious of making sure I get through this, Rory. The last two things I did talk about amenities. So the arms race for amenities still seems to be on in build-to-rent. And what we're showing here is the proportion of listings on Rightmove. So there are very specific listings you can have for build to rent, where you can list out those benefits, which I think we need to raise awareness of those. And what we've seen is back in 2021, and the proportion of listings, and we're comparing that with 2024. And you can see in almost all cases, there are more listings now proportionally who demonstrate that they have those amenities at their buildings or as part of their offering. So it's been increasing. Elements like shared workspaces have been increasing, private dining rooms increasing a lot. So some of those communal aspects, balconies and parking, and I think services including, the only ones where we're seeing fewer listings now than we back in 2021 having those elements to them. So the last chart or last slide I wanted to share, this is from my favorite bit of work we do every year, the Happy at Home survey. So we get 26,000 respondents to this, and we're asking people what makes you happy in your area. And I think this is really interesting in the context of build to rent. So we asked, and this is split for renters, I've split for renters here. And so we ask people how happy they are in their local area, and then we ask them a number of questions so we can get the drivers of that happiness. And what comes out every year, and particularly strong over the last few years, is that it's those intangibles, those emotional aspects which drive happiness in an area or in your home. So you can see here, being proud in your area, the fact you can be yourself. Those are the things that drive happiness. Amenities are really important, just not as important as some of those emotional and intangible aspects. And I think that's really pertinent for build to rent, because they do such a fantastic job at these buildings of promoting those communal aspects, those community-led aspects, the sustainability, those elements where people can be proud of the buildings they live in and the homes they live in. That really is sort of at the heart of build to rent, and I think it really does play into what makes people genuinely happy where they live. And I think we all would want people to be happy where they live. So that's a very quick run through some of the data that we pulled for this report. I'm going to hand on to Rory, who will take the next stage of what it means for people when they're actually in their homes in those build to rent offerings.
Thank you so much, Tim. Some really fascinating insights about how people's search for homes is changing. And I suppose that the natural iteration after that information is, okay, well, once they've found their home and they're living in it, what do they love? What do they want more of? What don't they like? And that's where HomeViews data has always come in. So just a quick summary, and everyone, I'm going to rattle through this because you are going to get the report. You can read it at your leisure. And I want to get on to talking to and having a really detailed discussion with the panel. But we're now 44,000 resident reviews on HomeViews. 15,000 of those are verified reviews in build to rent. And we, based on the most recent BPF data, we have a 92% coverage. That seasonally goes up. We were actually at 98% at the tail end of last year, but with new completions, etc., we've got a bit of catching up to do, which we will do no doubt over this quarter. But an incredibly powerful amount of information from from all segments. So this is single family, co-living and build to rent. One big change in this report is a reflection of the change within the market. And I know I will get my ear chewed off about some of these definitions within the build to rent sector, but we have segmented our data and analysis this year in the report, looking at what we call pure build to rent. So some of you might call that multifamily, but the purpose-built bells and whistles build to rent apartment blocks. We then segment the data by single family. We look at rental operators, so institutionally owned, professionally managed, but maybe not with all the bells and whistles you may see in a typical build to rent building. We also look at co-living, and then we obviously compare the resident experience within those segments to the build to sell market. In this case, in this report, we define that as for sale, and we also look specifically at housing developments where you have owners and tenants with private landlords and compare them to single family. But this segmentation is obviously a reflection of the market dynamics and the growing parts of each of these segments, but it also is to make sure that we're really comparing apples with apples as well. The headline from the HomeViews data is that the build to rent overall, the build to rent market has absolutely smashed it out the park from a resident satisfaction perspective. So we actually saw a dip in ratings from residents in 2022. There was a huge number of challenges. We were coming out of COVID, you know, there was everything that was going on within economically. I mean, not that we're in that much better shape now, but obviously a few less sort of hand grenades being thrown by the government at us. But the core of this bounce back in resident satisfaction, as you can see here, is that management rating. So a really stellar year, 2023, for the whole of build to rent. And you can see in terms of this data, the coverage is massively proportionally what we would call pure build to rent, but there's a growing segments within single family and co-living. So a huge pat on the back for everyone that is operating these buildings in 2023. And when we compare the build to rent resident feedback to for sale tenants, so this is basically what we would call PRS tenants in new homes. Build to rent residents are the happiest residents in the UK in new homes. And actually, tenants in for sale properties, their satisfaction on every rating is going down, and particularly when you look at that perception of value. And I think that's a huge thing, because we've seen, you know, obviously rents going up. Tim just said 8.5%, I think it was, Tim, in Q1 this year. You know, even with the backdrop of rents increasing, and often build to rent, whether it's single family, co-living, pure build to rent, is at the premium end of that. The residents are still feeling like they're getting good value for money, and that perception is increasing. So again, huge testament to the service and the management that's being offered, because that is the real differentiator. We're then able, and I won't go into too much detail here, but we're able to split out each of those segments of the build to rent sector: pure build to rent, co-living, single family and rental operators. Pure build co-living really holding its own, obviously on a small data pool, but with the resident experience in pure build to rent. Single family also performing really well, considering often there aren't the facilities on offer that you get in a build to rent building, but the customer service and the management really coming through in that. So lots more segmentation like this in the report. Something I did want to lean into, because there's a huge amount of investment coming into single family, as we all know. And it's an incredibly exciting, you know, moment in time to see how that market grows. And this is basically that, you know, that fundamental comparison we've always done: build to rent residents compared to tenants in new homes, PRS tenants. When we do the same comparison in purely housing developments, single family is ahead in every single metric, apart from location, which is interesting. I don't know exactly why that is. It might be because some of the single family projects that have been delivered to date have not maybe been at the prime location within that larger regeneration scheme. I'm not sure, but it'll be interesting to see if that changes. But anyway, single family residents are very, very happy, and happier in comparison to residents in housing schemes, either owners or tenants. Interesting bit, we talked about this earlier with the panel, the sweet spot of resident satisfaction. And I always get investors saying, well, is it the sweet spot for us in terms of what we should build? But the sweet spot from a resident perspective is 300 to 400 units. That is where you get the highest ratings in terms of the buildings and their scale. Typically, that's because they offer a significant amount of facilities. They might be part of a larger placemaking scheme. There's all sorts of management efficiencies at that level. But this has actually been consistent for the last 3 years across our data. And then we also take a deep dive into what amenities people love. Now, Tim actually showed some really interesting insight about what people search for. But once they live in the building, it is, you know, again, consistent with what we've seen in previous years: the lounge, co-working space, gym, being pet friendly. I'm not going to talk about pet friendly. We've had this discussion a lot, but being pet friendly is meaningful. But that it's that on-site maintenance and management. And actually in the report, what we do is we split out the facilities by each segment. So co-living, build to rent, single family, and we look at the frequency of facilities offered within those segments as well. So really doing a deep dive. We obviously do this all through HomeViews Pro, which is our data platform, which you'll see referenced within in the report. And then lastly, before we move on to the discussion, but I think one of the most important things to come out of this report is that the build to rent residents' perception of value, so their value rating, if they feel like they're getting value for money, has been going up and up. We had a bit of a dip in 2022, but in 2023, it's at its highest ever. And if that isn't testament to the fact that people are prepared to pay a premium for the service that's offered, for the security of tenure, for all of the things we know that build to rent offers, just the basics and the foundation of build to rent that you see in single family, this is it. This is testament to that. And the graph on the right that looks a lot clearer in the report rather than being squashed on the PowerPoint. What that shows us is even the highest cost build to rent offerings in local areas, so the highest that the buildings or the communities asking for the highest rents against embedded rental values, but also against the average build to rent rented values, they often have the highest perception of value. So what this is saying is you can charge a premium if you are offering the right building and the right service. And I think this is really interesting considering the backdrop of a cost of living crisis and huge rental increases. That's enough of me and Tim talking. I now would love to bring in our star panel to really talk about the challenges and the opportunities within the build to rent sector in 2024 and beyond. And Catherine, I'd love to come to you first. So as a multidiscipline operator, as a co-founder of a business, but really sort of boots on the ground, what are the challenges and opportunities you're facing in your space as an operator across a lot of these tenures?
Thanks, Rory, and thanks, Tim, for some great presentations and insights there. I'm going to probably sound, that was all very positive and all very buoyant and lots of happy residents, which is what we want, because happy residents pay their rent on time, they renew, they stay. This is what we want as an industry, is happy residents. I think our residents maybe see us like a swan. We are very graceful on top, but as property managers, our little legs are going behind the scenes an awful lot. It's a challenge as property management, so we have to be well, Verve Life as well, in terms of our client base and the units we're managing. We might be managing a single family housing block, a co-live block, or a BTR block. It could be anywhere in the country, and it could be at any stage. So it could be going in for planning. It could have planning, it could be mobilising, we could be doing a takeover from another property manager, or it could be coming out of the ground and we're, you know, working with delayed PCs. So the property management cycle in that early stage bit, it has its challenges because you're constantly juggling your recruitment and your team to make sure you've got boots on the ground as and when you need them to deliver for your clients and your residents. And with the best will in the world, I think all of the mobilisations we were expecting to either mobilise and complete tail end of last year, early this year, every single one of them has slipped. So that has challenges in terms of onboarding tech and onboarding people. And I think for us, it's exciting that you've got different hats that we wear in terms of the asset types that we're managing across the country. I think a big challenge, and this is where I'm putting a bit of a negative on, it is finding good people and hiring. Recruitment is an incredibly challenging market at this time. We're seeing build to rent salaries through the roof from an operational perspective. We're seeing people move very quickly and churn from jobs, jumping from one job to another, expecting salary increases. And we're not really seeing, I know build to rent's been going for a while now, but we're not really seeing people who have got necessarily the full 360 experience. You could be interviewing and somebody might be really strong on lettings, but they might not be really good on property management, or they're really good on community engagement. So Rory, I think that the people piece for me, when you're growing a culture and we're white labeling, so it's not just our culture, it's our clients' brands, to get the people in the right place in the right roles is a challenge.
And Ian, this is something when we were discussing this point the other day, and it's something that the ARL, previously the UKA, now the ARL, are very hot on, is creating sort of a code of practice, but also setting some industry standards around training. But Ian, you mentioned, you know, it's built to rent, although well established, it's still relatively young, and there is a kind of a lack of those established, you know, training routes for people. Is that right?
Yes. I mean, I'll maybe come on to the jobs part second, because I just want to just pick up on a couple of other points. I mean, I think there's quite an obvious trend, really, of an upward trajectory of, satisfaction and customer service satisfaction, because I think we're now seeing product on the ground that has been purpose designed and purpose built for rent. I've been in for about 10 years now, and really the last 5 has seen more of that product coming out of the ground. So the ability to deliver the operations efficiently and without problem, and the quality of product itself has gone up. So therefore, I think the satisfaction levels have gone up, and it would be a bit of a worrying trend if they weren't going up and we were doing that. I think that also creates a lot of opportunity for us to take that information that's coming out of the HomeViews report and really test it again against what we're advising people to do for design, because frankly, anything that we've got on the drawing board today won't be open till 27, 28, it's years away. And in some respects, that's the challenge that you have from an environmental perspective, in that you're now trying to accredit buildings that were on the drawing board 5, 6, 7 years ago, where standards of ESG were different. So there's a whole evolution in the product that has really supported an evolution in the customer service and the satisfaction levels that you're seeing. I thought it was interesting that Tim was talking about the happiness level, and the amenities were, low down that list. It's sort of, I'm rather hoping that people are happy, but they don't know why. But it's because they're in nice projects with nice amenities. So on the job side of things, I mean, I've been in multiple kind of new and emerging markets over my career. And it has always been a common problem that, the growth of the market probably outstrips the growth of the capability of people and their skill sets. And so what you get is you get a void of the number of people that you need versus the number of people that are actually out there. So, I mean, I always used to kind of talk about, well, if I'm an architect and I want an architect to go to the architect cupboard and I take an architect out, if I'm a build to rent operator and I want a service manager or a manager who's familiar with build to rent or operations and co-living and such, like, I go to the cupboard, then there's nobody in there because they don't exist off the shelf. So we're in that sort of process now of taking people out of other sectors, that have got hospitality backgrounds or airlines or such like, who've got customer service as a background, but need property training, and that kind of growth within the market is attracting people across the sector. I mean, from a consultancy perspective, I pick my new consultants, the young ones, out of the geography cupboard, because the geography cupboard has shown to me that they have got the skill sets that I need as the foundational level for my analytical work. So, it's that kind of thinking that we need to, bring through.
It's not an easy job managing these buildings, and you, Catherine, you alluded to it, having the experience of lettings, having the experience of running a building, and whether you're coming out of hospitality or others, when it's someone's home, it might be for many years, and the dynamic is different within these buildings, and it leverages a need for a lot of sort of emotional skills, practical skills, operational skills, and experience to deal with that. And it's a high pressure environment. So hiring and finding the right people is definitely, from an operational level, really up there. And we're hearing that a lot. And we're also seeing a lot of movement of people within the market as well, which is, it's great. It's great to see that people are staying in this market and they're growing their careers, but there is clearly a gap and a lack of really good, experienced building managers to cope with this increasing level of supply. One thing, well, to move on, everyone, just conscious of time, and please, anyone that's attending, if you have any questions, please do put them in the Q&A banner at the bottom. I think we've actually had one which I will come to as soon as I possibly can, but anyone else, please do add. So from Adam, coming to you, just bringing you into the conversation quickly, and we'll come back to the design pieces. Adam, you have a view of the US and the European markets that are obviously well ahead in terms of maturity. What trends and analysis can you take from looking at those markets and seeing where we're at, and how do we compare? What do you think is in store if you were taking the experience of those markets and looking at and overlaying that with the UK?
Yeah, really, really good question, Roy. And before I sort of answer directly, I'll just, a huge congratulations to you and to Tim and the wider team for the reports. I mean, as somebody who's been in the space like Ian for rather too long, I go back to I think about the private rented sector initiative back in sort of 2010, 2011, when frankly, this is a very cynical way of rescuing land values and getting developers to be able to do something with a sort of quasi alternate use. But I don't think people were particularly sincere at that stage. And we're now talking about the refinements of management quality. Like, we've come a long way, guys. It's a pretty amazing journey that we can talk about in first person now. So I probably worth at least highlighting that as a part of the overall operational theater. While the challenges still exist, their scale are different than they were when we started. But coming to your question, Roy, when you start to think about the international comparisons, is no great revelation for me to say that the last couple of years have been pretty torrid across the full real estate investment spectrum. But it's been, of course, fascinating to watch the relative rise of the wider living space, but particularly build to rent as a proportion of overall investment activity, with a high watermark in 2001, and in euro terms, about 120 billion euros of investment activity. Of course, that's fallen back in absolute numbers, but in relative numbers, the UK had the second successive quarter of multifamily being the largest segment of overall investment activity. So when I think about the maturation of the space, and we've had a really interesting discussion already on the operational side of build to rent and wider living, the maturation of the capital markets, the maturation of demand for and access to this segment of the market that has proven to be relatively more resilient than other sectors. And of course, the semi-existential crises around offices and retail still going through its thing. Industrials had chop and change, but multifamily and build to rent has just moved consistently through that space, and particularly recognize the resilience of the cash flow. That story, that message has been really important. But if you think about where the sector could go, if we're talking about crude numbers, multifamily representing around a third of investment activity, give or take, currently in the UK, and the US is closer to 50. Starts to talk about some really big net increases in absolute volumes. Of course, that's not sufficient enough. Just because investors want to be there doesn't mean that the sector is going to grow. You look at the fundamentals, and everyone reverts back to the fundamentals on the long term when you talk about build to rent. There will be an extra 3.6 million renters across Europe over the next decade. There is a surfeit of demand, while we're seeing proportional change within the rental segment for build to rent, for exactly the reasons that the report calls out, because it's of a higher standard, because it's beginning to be recognized as a better alternative from a value standpoint, regardless of the rent and the price point. That proportion of the net 3.6 in increase that will favor build to rent over the alternatives will just rise and rise. And that, I think, is a pretty clear and unassailable view. So the underwrite for investment activity actually looks at a fundamental level incredibly good. And you can see this isn't just an abstract story. You can see with the US numbers, as I say, scale of difference closer to 50% in overall proportion of the real estate investment spectrum. There's plenty of room for growth, plenty of room for further maturity in the space.
And Adam, thank you. I'm going to come back to you on the effect of the sort of commercial real estate landscape, but just a couple of points you've brought up, which actually lead me in very nicely, Ian, to some of your experience. There's a wall of money that wants to get into build to rent. We know that. We've seen a brilliant report recently, Knight Frank single family housing report, about the wall of money going into single family. That said, getting these developments to stack up from your perspective, from a consultancy perspective, is not easy. In the face, talk us through that, because I think that's one of the key challenges. There's a huge weight of money when these buildings get delivered. They deliver the best resident experience, but getting them delivered right now is not easy. Talk us a bit through that and your experience of that, Ian. You're on mute, Ian. Classic.
Absolute schoolboy error. I mean, if we ignore Adam's World and yields just for a second, and I will bring that into the conversation in a moment. I mean, on the ground, there has been a massive inflationary shift. So the cost of construction has gone up significantly, and it is beginning to level off and come back down again, which is good. But some design changes have obviously also impacted massively on the cost. So the second staircase, for instance, has dropped efficiencies internally from about 80% to 75%, and that 5% goes on to the bottom line effectively. There are a lot of new environmental legislation requirements and people wanting accreditations of home quality mark and wired score and such like. So all those things cost money. So there's been a sort of general pressure across the board to try and reduce the cost of actually producing these projects, because in Adam's world, the yields have gone soft. So what you're really looking for is investors have been trying to find places to make the gap back up between a viability, because their yields have moved out. We are starting, I think Adam's experience is much better than mine in this, but we are starting to see some yields coming back towards us, and that will help in the viability calculation. The cost to construct is coming back towards us, so that's beginning to help as well. But I also want to just relate this to a point that Tim made earlier, and you too, Rory, about the scale of development. So the sweet spot in terms of customer satisfaction on the ground of being around about the 300 to 400 mark, that's a very odd number, because 200 is the kind of number that you can get on the ground, 200 to 250 in a phase. Catherine will tell you that if we give her 400 units, she'll have a really hard time. Leasing velocity will get to a maximum level. You can't actually lease that number up much faster than you can, if you just get 250. So there's a bit of a phasing issue that you really want 250 plus 250 is the sort of ideal sweet spot. And 250 plus 100 doesn't really make sense, because that's 350. So actually 500 is a bit of a number that kind of makes sense, or 250 is a number. Now, these are kind of mobilization and cost issues that kind of come into play, but what it also sort of relates to is that investors who have been sitting on the fence and want to get capital deployed now want to spend big, because it gets money down fast. So they want big projects to invest in, because one legal bill and one transaction bill on a 500 unit scheme is much better for them than 3 200 unit schemes. So, it's a bit of a product of what's going on in the market at the moment.
Yeah, I do always get my ear chewed off by investors when I mention that 300 to 400 sweet spot, because they're like, well, what about the sweet spot for me to actually get these buildings delivered? What I would say is we categorize, what might have been multi-phase delivery buildings in that total figure. So appreciate you would never want, 300 or 400 units coming onto the market at once, or ideally you wouldn't, because of that lease up issues. But in terms of the long term, when it's stabilized, that's where residents are having the best experience. I've got a couple of, there's so much to talk about, but I also always want to try and bring in the questions from the team. So something that's come through, Nick Hunter from Cast. Hi, Nick, good to hear from you. We've seen that the software of good build-to-rent buildings management operation community is driving the highest resident satisfaction rather than the hardware, design and amenities. Controversial. I don't know if we'll all agree with that, but even though these buildings have been purpose designed for build-to-rent, what are the key lessons that designers and developers should be taking on to ensure that the software they offer can be implemented as best as possible? Well, I can see Ian shaking his head. Do we agree, guys, that the software is more important than the hardware? Are they equally as important? Maybe Ian, I think I know what your reaction is going to be. Catherine, let's go to you first.
I was hoping you were going to go to Ian first. No, go on. I want to hear what Ian says, and then
I'll go.
I might then challenge it.
So, so the uptake of software platforms across, actual consumers on the ground is 30%. So, people talk about apps on site, but the uptake is not 100%. It really isn't. So I don't believe that the software is driving the satisfaction. I think the interaction of the management company, Catherine's capable, on the ground interactions and the communications, and it won't all be through software. It'll be through various communications channels, but WhatsApps and others. So for me, the software isn't the driver. in facilities in general, it has always been the case that people only complain if something goes wrong. So the hardware is always in place, and people will only complain about the hardware if there's a problem, and they'll do that through the software. So, you know, it's not possible to complain about the hardware through the hardware, you know.
But Ian, so Catherine, this actually, we were at a round table, we were at a panel recently about, you know, prop tech, and Catherine, you've been, you know, really clear on this, that actually the amount of software available, and this alludes to Nick's question, is kind of suffocating. It's kind of overwhelming. And where are you at that journey with, you know, the amount of software your team have to use on a daily basis, and if it's a positive or a negative?
So we do use our software. It brings us management efficiencies, but it makes our residents' lives very happy, very engaging. And we do have very good take up on our resident app, actually, Ian, just to let you know. But we deploy it at really early stages. So it's where our referencing and tenancy progression happens as well. So that builds the resident engagement. But our on-site teams, where we've got them, if not our centralized teams, spend a lot of time doing push notifications and putting notifications through our app. In terms of resident engagement. And it might be, yes, the lift's gone down, so the hardware's failed, but it could be, yes, we're doing croissants on a Wednesday. In terms of the tech, yes, there's a lot of different tech challenges out there. And when we set Verve Life up, we spent a lot of time looking at tech. And the challenge we have as an industry is not having a tech specialist within Verve Life. We were trying to get best in class to bring us efficiencies. But before the call, I made a list of all the different platforms that we use. So we've got your property management system, which might be different for co-live, single family housing, or build to rent. You've got your resident engagement app. You've got your health and safety, PPM and compliance. You've got maintenance logging. You might have an ESG platform. You might have a client's bit of tech that you need to deploy. You've got your deposits, your referencing. You've got your other platforms, which are amazing, like HomeViews and Rightmove. So when you add all of those tech stacks up, if they can't talk to each other enough, you need a full-time job to get the efficiencies. And that's then where you end up with resident complaints because something's fallen through the gap. So the tech bit is a really big piece, and there isn't one shop fits all. There is no product out there. And when you've got multiple clients who've got multiple agendas, it might be ESG is high for somebody, but resident engagement is high for somebody else. That's a third-party operator challenge. It's also an opportunity. It's an opportunity where we are to embrace and be very agile and look at moving into the next best thing that's coming to the market and the next best product.
So Jess Glover from Ask4 has actually just reminded us that we've got to do a survey after that round table. So
and in fact, Nick, Adam, sorry, just 1 second. Nick's actually just mentioned he meant software in the broadest sense, i.e. anything that wasn't bricks and mortar. Nick, from our perspective, as you'll see in the report, some of the top rated buildings for facilities actually have very limited offerings of facilities on HomeViews, and it's when they manage and use what they've got incredibly well. And to answer your question, as I've been banging on about it, and everyone's probably bored of me saying, you can have a relatively basic building, brilliantly managed with a fantastic ground team, and it will deliver a comparable resident experience to a very highly amenitized building. At the end of the day, a highly amenitized building with all the bells and whistles is very difficult to manage at a very high standard, you know, going back to that point. So Adam, sorry, I cut you off. You were about to say something.
Well, in fact, you've sort of teed me up as well pretty well, Rory, so that's worked out. I mean, I kind of think of it as a bit of a false dichotomy in that, you know, hard and software clearly reinforce each other when they're done well. From an investor perspective, when you look at viability, clearly the reason why technology gets so much attention is that it's got a very short half-life. 2 and 3 years can be the life of really good ideas, whether it's hard or soft tech. And as a result, it gets perhaps an overweight level of attention. But the point that you just ended on for me was where I think the marriage value is worth considering. Really, really good management, really good customer experience can be enabled through soft and hardware, but certainly can't be replaced through soft or hardware technology. And it's genuinely good management in the human to human sense that for me passes the time, that continues to evolve, and the investment in the people as much as the systems becomes, I think, the most important piece when you're thinking about the viability of management and schemes. So I think it was just important to say that it's a natural tension, it's obvious, but ultimately I think it distracts us from the core value, which is in human management.
I couldn't agree more. I can't believe we've only got 15 minutes left, guys. What have we? Time has flown. So we have a lot of questions. I'm just going to get one out of the way. Rajan, which in terms of amenity usage, what would be the top 5 used in amenity spaces within build-to-rent buildings that have 300 units plus? Roger, actually, the report will give you a really good outline of that. So I'm gonna leave you to download the report. Everyone, you'll be getting a link this afternoon, probably at about 4:30 to download the report. And if that doesn't answer your question, Rajan, please let me know and we will come back to you. Camilla Cunningham, what are your views on senior living build-to-rent villages? And are you seeing greater demand? Noting what is important, senior living might be different to build-to-rent. Tim, putting you on the spot, do you have any view from a demand perspective at Rightmove on senior living? Is that something that we capture? No, not at the moment.
I can pick up that a little bit, Rory. So in the US, there's a model called continuing care retirement communities. So CCRC is the non-deployment for that. And that's quite a mature model. I mean, it's almost as mature as multifamily. It is effectively a typology that's like multifamily, specifically designed for people who are aging. And, so there are additional care and design things that are brought into bear. And that is a model that I think we'll start to see come into the UK. And, I can see growth in that market coming. And, in the US, that sort of gated community is a thing that everybody talks about. And I wouldn't so much call it a gated community. It's just a typology of similar type units in the same place. And, you do get that with McCarthy and Stone currently in apartment living and such like. So single family housing is probably going to have, there are examples of that already, but single family housing is probably going to address that. And you will see villages turning up. There are, there's one actually not far from me called Auchlachen, only I can say that, which is near Lesmahago, which is that's probably 20 years in life, and it is a village for seniors,
I think just to chip in there, Rory, we're certainly seeing more inquiries from our investor and developer clients wanting to look at later living. It's how you define later living. I think 50 is very young now. Communities. I think I certainly look at the age of my mum, and she's fit and healthy, and she couldn't think of anything worse. I think multi-generational is actually a healthy future, and I think there's from an operator perspective, there's those blurred lines between care, assisted living, and whether it is just an age-restricted later living rental community. I think we're a way off. I think we haven't nailed build-to-rent in this country yet. We haven't nailed co-live, and we haven't nailed single family. So it's definitely got its place. It's just really interesting to see how that market will emerge. There's a place for it, just what it looks like.
There is a Scandinavian model where students and later living people are together, which has proved to be very interesting.
Students pay a discounted rent, don't they? Or the ability to pay discounted rent, and then they can support the elder residents in the building by doing shopping, and then or families, so the older residents can do childcare. I think multi-generational living, it's what you see in long leaseholds. So why would you want to segregate? It's not healthy, in my view.
And I definitely think with the increase in rental offerings that have houses and apartments on the same site that we're going to see more of, I think we'll actually naturally see that intergenerational living play out. Lots of questions coming in. Thank you. One thing I did want to just talk about before, and I'm very conscious of time, so let's try and answer these as snappily as we can. One of the big things that came through in Tim's data was the awareness of build to rent, and it is increasing. But Tim, just remind us, like, some of those stats, 28%, but it's going in the right direction, but there's still a lot of work to be done to educate people who are looking to rent that build to rent is a thing and what it offers, isn't there? What's your kind of take on where?
Yeah, I think it's a twofold thing from what we've seen and from talking with tenants over the years. There's the awareness of it in the first place, and then there's the benefits of it. Because I still think, I think it's really interesting when we survey people and ask them, first-time buyers, why they want to buy, for example. One of the main reasons they want to buy is because they don't want to rent. So it's like it's a push from the rental sector and sort of avoiding or missing all the benefits that there are about renting, all the wonderful things like the thing, not having to fix your roof, for example, or not worrying about finding tradespeople and the cost benefits of that and the flexibility, the community elements, all these things around renting, which build to rent really delivers, and multifamily, and is going to increasingly deliver from a single family perspective. There's awareness of that, I think, which there's loads of opportunity to increase that at the same time as increasing awareness of the product in general. But I think you probably have to do both at the same time if we want to drive this forward. But there's loads of opportunity.
Well, I think the big thing on that, one of the stats, and everyone has a different view of how many completed units there are in build to rent. But if you take the BPF data, we're at around about 100,000. It's a tiny proportion still, right? And so that is always going to dictate the number of people that are aware of this product. But obviously, single family and the huge growth in that we expect to see will have a big impact on that. But and this is the perfect segue I was looking for to Adam. Commercial real estate, what is going on in the commercial world is going to have a significant impact on rental. And Catherine, you mentioned yourself that actually a number of the buildings you've got coming up to operate a permitted development. So Adam, just quickly, what is going on? What's your view on what's going on in the commercial real estate world, and how is that going to impact build to rent? Positively, negatively, what's your view?
Yeah. Well, I mean, let's focus narrowly on the story in offices. Most will be aware of the bifurcation of value between offices that are premium and highly prized and sustainable net zero and are driving very strong rent trajectories. The vast majority of offices are somewhere in a space of moving towards either serious refit from a sustainability standpoint or obsolescence and the need for repurpose. Now, the obvious repurpose in city centers is going to be living. There's some leisure, so hotel take up as well. But the JLL research on this would suggest in London alone, something like 43,000 flats will be generated through the cycle on the back of office obsolescence across Europe. We talk about a figure of something close to 60 million square meters of space that will become obsolete in the next 5 years or at risk of obsolescence. So we're talking about a change that is pretty normal. We've been seeing it for some time, but at an accelerated rate. What for me is really interesting in the UK is the extent to which we invest in our towns and cities to make them livable, to benefit from this opportunity of new urban living sites that will come forward. And importantly, as we were chatting about with Catherine before we started the call, upholding the quality of the product. We've seen plenty of permitted development right stock come forward that really, frankly, doesn't shower us in glory as an industry. And it's really hard when you're speaking to government, as I do, to make the strong case for this vibrant opportunity of great livable cities through build to rent, through multifamily, when the examples are, hang on a second, you guys turned us over on this last time. We've got to think carefully. So as an industry, we've got our homework. We've really got to fix this, but the opportunity to benefit from a pretty significant structural change in the office market for living is I think a really exciting shift through the cycle.
Yeah, I absolutely agree. I think it's really valuable. We've got 3 schemes that are mobilising at the moment: Birmingham, which is open, Salford Quays, which is an office to resi, and Glasgow soon. And for us, they're great buildings. They've got lovely amenity space. They are on the smaller side. They're not the 300 or however many hundreds we were talking about. We're kind of 150 units. I think it's really important to breathe life back into the high streets as well. If you look at Barcelona, Paris, you've got that metropolitan living, you've got that cafe culture. We don't have that in the UK. And I think unless we really consider looking at the office to resi conversion, especially on the high streets, there don't have to be a huge number of units at any one time. It could be 20 or 40. You're then still breathing life back into the high streets in the evening, which is only great for the economy, isn't it, at the end of the day? Reducing travel, reducing car use, all of those good things. So I think it's definitely got its place.
Yeah, I think it could also help answer the question that Tim Stephen posed as well about ESG. So, I mean, we won an award for the One Cow Caddens project in Glasgow, which is an existing building, and it was all about the whole life carbon calculation, which investors are extremely interested in. You know, from an urban regeneration perspective, makes a lot of sense. I mean, a lot of office space is in very good locations next to transport hubs, retail outlets, you know, leisure facilities. So actually generating them, you know, some of the retail side of it out of town and repurposing some of the city centre stuff for residential makes a lot of sense, not just from a living perspective, but from an ESG perspective.
It doesn't, and actually, just we've done this in previous reports. A number of the top-rated build-to-rent buildings on HomeViews are office to resi conversions. And actually, there's a case study of the Keel in the report, which was office to resi, I believe. Ian, you'll probably know better than me.
Yeah, it was.
And it's one of the top-rated buildings in the whole country, full stop, but also one of the top-rated for facilities. So I totally agree with you, Adam, that the permitted development hangover, particularly from the sales market, that conversation needs to be repositioned, because it's a huge opportunity. And it goes back to that point. More of these buildings being converted to rental in these core locations, but regionally, more single family. That is how consumer awareness is going to grow, alongside built for renters listings on Rightmove, which obviously differentiate those listings from a standard PRS listing and shows the facilities and the offering that you get. But it needs to be supply, and then you need to get that consumer recognition.
I think the Keel's an interesting project to pick, and I'll just very quickly, but when Matt Smith also got a hold of that building, it massively jumped in its HomeViews outputs. So the building didn't change massively. They probably had some refresh inside, but I mean, the fundamentals of that building stayed the same. It was the management that actually turned that building around, because it wasn't good before and it is good now. So I think there's a software, hardware. I think describing it as software is maybe not. Soft services versus hard services maybe might be the right dominant.
Will, I'll have to have a word with Nick afterwards about throwing us down the wrong route on that. But anyway, we have got 2 minutes left. I really want to try. So I think we've alluded to Tim Stevens' question. Tim, thank you. Will Ramshaw, will we be able to share the slides that Tim shared? I think we will share, if not all of them, some of them. And there will be a replay, a recorded session of this webinar emailed to all of you. David Whitlock, thank you for asking. Obviously, you want to share it, please do. 1 minute left. Very quickly, from each of you, what is your biggest challenge and your biggest opportunity for build to rent in 2024 and beyond? Catherine.
Biggest opportunity, I think, is delivering for our clients with the right people in the right places for the right assets at the different stages of the projects. That is a challenge for us. An exciting challenge and a nice problem to have as we're growing. I think an opportunity is the growth of single family housing and co-live. And I think we just need to make sure it's not detrimental to the growth of BTR. I think it's those asset classes and defining them is a huge growth and opportunity for the sector.
Very articulate. Thank you, Catherine. Ian?
35 years in corporate real estate has taught me that there is never a time where there is not a speed bump that you have to get over. So the opportunity is working out how to get over the speed bumps is basically it. So, and really, you know, people who are thinking at the earliest possible juncture about how to design and build and operate their buildings are out turning product that will give high customer satisfaction ratings and will give Catherine an opportunity to deliver good operational outcomes and will deliver to Adam's clients a high return.
Tim?
Yeah, I think challenges and opportunities, two sides of the same coin. I think it's the awareness and the benefits I would come back to. The benefits of, you know, all the work designing those buildings and the work Catherine and her team do to make sure that those people who live in those buildings have an amazing experience. I think we need to get more people aware of that and experiencing it and feeling it. So getting people into those buildings, you know, to visit friends or whatever else it might be, to see with their own eyes how amazing they are, and to talk about those benefits and talk about them more on Rightmove and so on. And lastly, I would mention sustainability. So environment and sustainability, as Ian has, I think there's a real opportunity for build to rent who are leading the way in this space versus the PRS sector to really make that a big benefit for the people who really want that as part of their home and what their home means to them.
Well said, Tim. Thank you. Adam.
Well, Roy, not to sound like a bit of a sycophant, but having created this sort of evidence base to be able to make the arguments that the sector, the industry needs to make to government, recognizing that living investment, build to rent, multifamily, single family, the spectrum can be a central catalyst to our economic future, to undermining some of the very big structural challenges we have in this country with respect to housing supply, can be a really vibrant part of the future. Those arguments were incredibly difficult to make before reports like this came through with very demonstrable and clear evidence that what is being created is improving lives, is making the quality of the living experience a better one. And so as a result, I sort of think about that space. The bottleneck for me is getting policymakers, local planning communities to look really objectively at this shift that is happening with respect to commercial and residential, the shift that is happening with respect to opportunities on new sites in urban locations, and saying this thing here, this is a part of the answer. So that's mine.
I couldn't agree more. And what a brilliant selection of opportunities and challenges from a fantastic panel. Thank you so much for joining me. Everyone that joins, thank you very much for, I hope you enjoyed it. You will be getting an email with a recording of the webinar and a link to download the 2024 HomeViews Build to Rent report in partnership with Rightmove. Thank you so much. We are just on time, slightly over. Have a great day, everyone. And we'll see you next year.
Thanks,
everyone.
Thank you.